All right, here we are again. So tonight we'll be wrapping up our discussion about equities and equity risk. In particular, we're going to be introducing a very, very famous model in finance called the capital asset pricing model. And it is designed to help measure the risk of owning either a share of stock, or else a portfolio of stocks. It has a very interesting history. And we, even to this day, even though this model's been around for quite a few years, it's still being used to this day, which shows you that the market really does take it seriously. And so we'll start by introducing this model and explaining what it is and how it works. Okay, now, just as an aside note, this is only one of many potential models that could be used to represent the relationship between risk and return for stocks, but it's one of the more popular ones. So in other words, you might say to yourself, well, I don't like this model, I'll use something else. That's fine, but just be aware that a lot of market participants do use this model to help them understand the relationship between risk and return for equities. And it's also very useful in corporate finance applications. You'd be surprised how often it shows up. Like imagine yourself being a corporate analyst and you're trying to understand the relationship between how much debt and equity your corporation has and how much risk is involved. You know, this CAPM model is going to give us a lot of helpful insights into what's actually happening with the company's debt and its risk. And so we do see this used quite often in financial applications. So what exactly is this model? Well, as you can see, the title is the capital asset pricing model, but basically what it does is it gives us an alternative way of looking at the relationship between risk and return. And in fact, this model originally was intended to be sort of a streamlined version of what is now called modern portfolio theory. So with modern portfolio theory, we are basically analyzing the risk of stocks in terms of a statistical measure called the standard deviation. And this standard deviation is a way of explaining how volatile a stock is. In other words, how much do its returns change over time? So in the financial markets, the word volatility or volatile, it refers to the uncertainty over the returns to an asset, and it is often measured with the standard deviation of the returns to the asset. And in fact, there's a separate branch of finance called the modern portfolio theory, and that's basically how it explains what's happening with stocks. Modern portfolio theory, which we're not going to cover here, it's just, you know, it's a little too intense for the time frame that we have. But modern portfolio theory explains the relationship between risk and return for stocks or equities by assuming that investors must be compensated for bearing risk in the form of a higher standard deviation with higher expected returns. Okay, so in other words, the modern portfolio theory basically says investors are really focused on two things: expected return and risk as measured by the standard deviation of a stock's returns. Nobody's going to hold a stock with a very high standard deviation unless there's a realistic expectation of getting a relatively high rate of return. So modern portfolio theory was developed in the 1950s by Harry Markowitz, who eventually won the Nobel Prize, by the way. And it's a very powerful theory, and it's used in a lot of different applications in finance. The only problem that it had was that in order to implement it correctly, it really requires not only massive amounts of data, but a lot of computer processing time, which in the 50s was at a premium. In other words, right now we've got powerful computers all over the place. I mean, even the laptop on your desk right now is infinitely more powerful than whatever was available when Markowitz was writing his theory. So it was a real problem that for the modern portfolio theory, that it took so much time and so much data to implement it. So the capital asset pricing model was developed, among other reasons, to not only just provide an alternative look at risk and return for stocks, but to actually streamline the calculation process so that results could be obtained much more quickly and easily without needing quite so much data or so much computer speed. So that was one of the reasons why it was popular right off the bat. But there are good things and bad things about the CAPM model. The CAPM, which, by the way, in case I didn't mention it, stands for the capital asset pricing model, is an alternative to modern portfolio theory, which explains the relationship between risk and return to stocks in a somewhat different way. And it has the advantage that it is less computationally intensive, but it is based on several very strong assumptions, which now, by the way, all models are based on assumptions. The question is, how strong are those assumptions and how realistic are they? And even then, if we have unrealistic assumptions in our model, as long as the model works, the assumptions are not really that important. In fact, there's a very famous saying from the economist Milton Friedman, another Nobel Prize winner, who said, the validity of a model depends not on the realism of its assumptions, but on the validity of its predictions. So in other words, he was saying that, if a model is based on unrealistic assumptions, it's not that important as long as it's doing a good job explaining what happens in the real world. So the CAPM has a lot of very strong assumptions, which were necessary to make the model more manageable. In other words, the reason why it doesn't need so much information and why it doesn't need so much computer time is because it's simplifying a lot of things that modern portfolio theory is not. So that's kind of the trade-off with a model. You can have, the more realism you expect or require from it, the more time, the more effort, the more complex your model is going to be. So the CAPM is meant to be a bit more, let's say, less time consuming to implement properly. So, now that does cause a lot of issues. I mean, it's like any other model. We have to take it with a grain of salt, but it does have a lot of very useful features. Okay. So anyway, how is this model structured? How is it set up? What does it tell us? So basically, we start by assuming the existence of what we're going to call a market portfolio. Okay. Now, this market portfolio consists of all the assets in the economy, but not equal amounts of each, okay? Where the weights or percentages held in each asset are based on their what's called market capitalization or value or dollar value in the market. Specifically, the market capitalization of a stock equals the dollar value of its of the outstanding shares. Actually, sorry, I shouldn't say that. It's not the market cap of the stock. Usually we're thinking in terms of the market cap of the corporation equals the dollar value of its outstanding shares of stock. So for just a quick example, suppose a company has 1 million shares of stock outstanding. and the market price is $100 a share, then the market capitalization would be of this company, as you can imagine, $1 million, a million times $100 a share. $100 million. So the market portfolio, imagine this huge portfolio where we put into it every asset in the economy, every single one of them. But the amount depends on the market cap of that asset. So, for example, there would be a lot of Apple stock in this portfolio, but not as much of other assets where, like smaller companies, let's say. So now, of course, there is no such thing. And this is already kind of an issue for the CAPM model. In practice, the Standard & Poor's 500 is used to represent the market portfolio. And of course, it makes sense because remember, the Standard & Poor's 500 is an index that represents on the largest 500 US corporations ranked by market capitalization. So in other words, Apple is clearly on top of that list, and then we work our way down to the smaller companies. We could probably find a quick list of what's in the S&P 500. We'll just quickly take a look at that. Well, no, that's the NASDAQ. Why did it show me the NASDAQ when I asked for the S&P 500? I mean, really. There it is. All right. Oh, look at that. Microsoft sneaked into first place there, and so did NVIDIA. Look, Apple's only number 3. What happened? Well, so they're just slightly under $3 trillion right now. So Microsoft is at 3.5 trillion. NVIDIA is about 3.5 trillion. Apple just under 3 trillion. Amazon about 2.2. Alphabet is Google. There's 2 different versions of their stock. That's why it's written like this. Meta, which is Facebook, et cetera, et cetera. But you can see these are the really big companies, but they gradually work their way down. And at the very bottom of the list, we'll see. Let's see what's on the bottom here. Invesco, 6.5 billion. Okay. Now, so what happens is when this index is constructed, they don't just simply put in all 500 shares and then average them out. What they do is they put an amount of stock proportionate to their market capitalization. So if, for example, Microsoft represents, let's say, 10% of the market capitalization of the entire S&P 500, well, then 10% of the index will be Microsoft stock. And then it works its way down to the smaller companies that have progressively smaller weights or percentages. And then that's how this is constructed. So the weights or the proportions that are held in each stock are based on their market capitalization. Now, since this is what the market portfolio in the CAPM is supposed to be doing, that's why this is actually a very good approximation to what a market portfolio would actually look like. It's just that it's only the 500 largest stocks. It doesn't have anything else in it. It doesn't have other assets like gold or silver or anything like that. And it only has 500 stocks, but it does a pretty good job of representing the market portfolio. Now, having said that, there are organizations that produce these. The numbers that are produced for the CAPM model can come from many sources, and not everyone agrees that the Standard & Poor's 500 should be the market portfolio, but most of them do. Okay, there can be differences of opinion. Now, the CAPM model also requires us to estimate what's called the risk-free rate of interest. So what this basically refers to is this can be thought of as the yield to maturity of a treasury security, because those are really the only securities in the market that are free of credit risk. The question here then is, what maturity should we pick? So again, there can be some differences of opinion. We could use the 3-month treasury bill rate. We could use the 10-year treasury note. We could use some average of both. So we'll assume that when we see CAPM model numbers being produced, that they're based on a risk-free rate, which is a treasury yield somewhere between 3 months and 10 years. Okay, so again, it's not absolutely clear what maturity we should be using. So there can be differences of opinion about this. And then one of the most important outputs of the CAPM model is a unique measure of risk known as beta. Okay, so if you look on a website like finance.yahoo.com, you'll see all the stocks have a beta listed because, like I said, this is a very popular measure. This CAPM model is very widely watched among stock market analysts and portfolio managers. And so let's just say we decide to take a peek at Apple's beta. And it'll be here. Although I must say, the last time we looked at this website, a lot of the information was missing. I don't know what was happening, but if they don't have it, maybe we can find it somewhere. Oh, here we go. There it is, 1.21. Now, it's, of course, we don't know yet what that means. We'll find out pretty quickly, but just in a nutshell, the beta measure represents or reflects the risk of a stock. So the way it's defined, the beta of a risk-free security is 0. Okay, so any treasury security would have a beta of 0. The beta of the market portfolio, which means the S&P 500 basically, is 1. Okay, so these numbers worked out very well because this means that, therefore, if a stock's beta is greater than 1, it is considered to be riskier than the overall market. Okay, so Apple's at 1.2, so that means the market, according to the CAPM model, is saying Apple is riskier. A share of Apple stock is riskier than the average stock, let's say in the S&P 500. Now, that seems a little hard to believe. I don't know. You'd think that it would have a lower beta, but it may be that, for example, if they're doing a lot of their business in China and there's a lot of political uncertainty and that kind of thing, that could cause the beta to go up. Now, of course, if the stock's beta is less than 1, you could probably guess it is considered to be less risky than the overall market. So let's try something stable like Coca-Cola. Let's see what their beta looks like. 0.46. Yeah, see, that's pretty low. Meaning that, what would it take for Coca-Cola to suffer massive losses? I don't know. It doesn't seem likely. So it's one of those companies that's been around forever. Their growth prospects are fairly minimal, but it's a very steady, stable stock. Even if you don't have a lot of capital gains, you'll probably get some nice dividends. So it's a good stock for investors, and it isn't terribly risky. Okay, now sometimes you find stocks that are pretty, let's see what we can, I think Tesla is probably at a very high level right now. I'd be willing to bet it's over 2, which is very high for the beta CAPM, by the way. 2.46, yeah, that's what I thought. 246, that's a very high beta, which means the company is producing a lot of new products, new cutting edge products. Let's put it that way. In other words, they're bringing out self-driving cars and robots, and they're involved with space and all this and that. So clearly, the company could do spectacularly well in the future, but they could also go out of business if things don't go right. So of course, they're going to have a very high beta. Now, according to the CAPM model, then the return to a stock will be directly related to its beta. The higher the beta, the higher the average return should be. So in other words, actually, let me change that to average return. It doesn't have to be that every year. In other words, on average, if you hold a very high beta stock, your return should be very high on average. And then the same thing is true with the low beta stock. Your return should be fairly low on average. But you never know from one year to the next. It could change a lot too. All right, so that's kind of where we're heading with this CAPM model. Let's take a closer look at it. So again, yes, we assume the existence of a market portfolio. In practice, we're using the Standard & Poor's 500. The beta is it's essentially a measure of how sensitive a stock's returns are to the overall market. If you want to get super technical about it, you can read up about the statistical measures that it is based on. For example, I'll just briefly mention this, even though we're not going to do the actual statistics. The beta of a stock depends on the volatility of the stock and how closely the returns of the stock track the overall market. Okay, so in other words, a stock that tends to rise and fall with the market is going to have a very relatively high beta. And the ones that are somewhat independent of the overall market will tend to have a lower beta. Well, let me give you a quick example of this. I think we even already used this company as an example, Procter & Gamble. We would expect Procter & Gamble to have a low beta since its products, or I should say the demand for its products is more, well, not very closely related to the business cycle. Meaning that they're making things like shampoos and soaps and detergents and things like that that people will use regardless of what's going on in the economy. So if we come back here and take a look at their beta, PG, oh, okay, hold on. PG, it's missing. But I know I've looked it up many times before. It's going to be right around the same neighborhood as Coca-Cola, meaning, quite a bit under 1. And that's the reason, because, when things are good in the economy, Procter & Gamble will do fine. When things aren't so good in the economy, Procter & Gamble will do fine. So they won't ever experience explosive growth or anything like that, like Tesla could. But, it's a good, steady, stable company. So the beta is going to be fairly low, right? The very risky companies like the Teslas are going to have a very high beta because while they're very risky, the upside potential is enormous. Okay, if those robots work out for Tesla, they can make a fortune, and in fact, they expect to do exactly that. It's like one of those things where whoever gets there first could scoop up all the profits, so they want to be there first. Okay, all right. Anyway, so Now, here's the equation that will be used to reflect the relationship between risk and return. Now, every book does this a little bit differently, but the same variables are used in every case. What exactly are these terms telling us? Well, this is the return to stock I. This is the risk-free rate, meaning the yield on a treasury security. This is the beta of the stock. This is the return to the market portfolio. And this is, again, the risk-free rate. All right, so let's take a closer look at this thing and see what they're trying to tell us. All right, what is this all about? So if you look at it carefully, now here's the risk-free rate. So the way the formula is set up is that if an asset has a beta of 0, you can see that algebraically, the return will be equal to the risk-free rate of interest, which is what you would expect. Okay. So in other words, if this beta is 0, then this whole second term drops out, and we're left with the risk-free rate of interest. Now, at the same time, though, if an asset has a beta of 1, as the market portfolio does, then the return will equal the return to the market portfolio. And so in other words, if in that case, I would have 1 equals RF plus the beta is 1 for the market portfolio. So this equation says RF. Whoops, no, sorry, the left-hand side is not supposed to be 1. That's the return. Anyway, so yes, so you can see algebraically RM. Now, some assets in the economy do have a beta of 1. It's not just the market portfolio. The assets that very closely follow the market, overall market, can have betas of 1 or very, very close to it. So what this is, a formula is saying to us is that for a risk-free asset, we, again, expect to see a return equal to the risk-free rate. And if we have a stock that closely tracks the market portfolio or the market portfolio itself, the return will be just the market rate of return, whatever RM is. Everybody else will have something in between. Okay, so the difference between this is sometimes called the market risk premium. And what does this represent? All right, well, think about this. By the way, this number is always positive. The return of the market will never fall below the risk-free rate. So this number is positive. Think of this as this is the compensation investors earn for holding a risky asset, or sorry, the market portfolio, instead of the risk-free asset. In other words, if you take a risk by buying, let's say, the S&P 500, you have to be compensated for it with higher returns compared to simply just buying treasuries. And so this difference is that compensation. Because otherwise, if you didn't get compensated for bearing risk, everyone would simply put all their money in treasuries. So this market risk premium tells us how much extra return people expect to get in exchange to hold the market portfolio instead of treasuries. So when you look at the model altogether like that, what you're seeing here is that the return to an asset or stock comes from two sources: the risk-free rate, which all assets have to pay at least that much, otherwise nobody will buy them. This is the premium for holding or bearing risk. Okay, so the part inside is the market risk premium. When you multiply by the company's beta, then it becomes the risk premium for that stock or that corporation. So in other words, this part, RM minus RF, that's the same for everyone. That's the return, the extra return you get for holding the market portfolio. If you have a very, very risky stock with a very high beta, then the risk premium would be higher than it would be for a safer stock. So you can think of this as the risk premium for asset I or stock I. So in other words, here, this is the part that's unique to that stock. That beta right there directly impacts on the risk premium you're getting. The higher the beta, the higher the risk premium. Okay, so you're getting some multiple of the market risk premium in exchange for buying a risky stock. For a Tesla stock, you're going to get a very high risk premium. For Coca-Cola, you're going to get a very low risk premium. Now, in a marketplace like this, there's going to be a lot of buying and selling. People will buy and sell according to their expectations of what's going to happen to these stocks in the future. So you may find that some stocks appear to be overpriced, some are underpriced, and investors will make their decisions based on that. But they can use this as a starting point to help them understand what should be the correct return to a stock before they buy it. So let's see, what else do we have? Oh, okay. So here's a quick numerical example. What if the risk-free rate of interest is 3% and the risk premium of the overall market is 7, meaning the spread between what you can earn by owning the Standard & Poor's 500 and the risk-free rate of interest, which in turn, by the way, means algebraically that the return of the market must be 10%. Okay, so in other words, the only way that can work out is if RM equals 10%. Okay, now we have 3 stocks here. Now, I completely made up these betas, by the way. They may not have any relationship to reality, but let's say these are the right betas. This means that we can use this CAPM model to predict what the returns should be to these stocks in the future based on all this other information we have. So remember, this is the risk-free rate. And this is the market risk premium. So for this stock with such a high beta, 2.1, this is Ford, the model predicts on average we should get a return of 17.7%. All right, 3 of that from the risk-free rate, and then the market risk premium is 7, but our beta is more than double that. So therefore, we should ultimately end up with 17.7. All right. Now for IBM, which is 1.4%, not percent, sorry, it's just 1.4. It's a multiple of for beta. We replace the beta here of 2.1 with this beta. And of course, you can see that lowers the average or expected return to 12.8%. Instead of 17.7, on average, we should expect to get 12.8%. And then finally, the last case is GM at 0.9. And you would expect the lowest return of them all from General Motors because it's the least risky. But how much lower is it? If you replace the beta with 0.9, keeping everything else the same, you can see we're down to 9.3%. Now we can graph this relationship very easily. We're going to create something called the security market line. And the security market line shows the relationship between the risk and return for different stocks based on these results. So what we can do is just go through and imagine or just recalculate this equation with every possible value of beta, and we'll end up with a straight line. That line is called the security market line. So let me just jump ahead. Here it is. Let's grab this and copy it to my notes so we can see it better. Well, it's refused. There we go. Not cooperating tonight, I see. All right, let's show that one more time. What do you know? This time it worked. All right, so here's what I wanted you to see. On the vertical axis, we have what's called the expected return. To stock I, you notice there's a subscript I there. On the horizontal axis, we have beta I. This is the risk of each individual stock. The risk-free rate is over here. And if you notice, it's on the vertical axis because the beta is 0. All right, so this refers to the yield on a treasury security, which is risk-free, which means it has a beta of 0. And then if you notice, all these returns and risks are connected with a straight line, meaning that the CAPM shows what we call a linear relationship between risk and return. Now that makes it easier to implement this model, but it also makes it easier to visualize what's happening. And it also means that it's easier to calculate the beta of an entire portfolio of stocks than would be the case with modern portfolio theory. So it's a linear function. It's a straight line. Okay. Now the intercept is over here. Oh, and by the way, this line is often referred to as the security market line. Okay, so the intercept of this line is the risk-free rate of 3%. What about the slope? Remember from your travels, the slope is the rise over the run, meaning the change in the expected return given the change in the risk. So in other words, if I add one more to my beta, how much extra return am I getting? Well, that turns out to be the market risk premium right here, RM minus RF. So again, if every extra beta I add to my stock, I should expect a return that's higher by the amount of the market risk premium. So in this case, remember the market risk premium in this example is 7%. So if I add 1 to my beta, that'll add 7% to my average or expected return. Okay, so that's how the model is set up. It's a very nice model. It looks very pleasing. Is it realistic? It can have its issues. Now, here's what's interesting about it, though. This CAPM model is an equilibrium model, which you'll recognize from when we talked about supply and demand in the beginning of the semester, which means that if a stock is not on the SML, it is either underpriced or overpriced. If the stock is underpriced, investors will buy it. The price will rise. The expected return will fall until the stock returns to the SML and is therefore fairly priced. Okay, notice consistent with market fundamentals. If, of course, the stock is overpriced, investors will sell it. The price will fall. The expected return will rise, again, until the stock is fairly priced. And it returns to the line. So this is what they mean by an equilibrium model. If you remember, in equilibrium, let's say with supply and demand, if we're not here where we belong at equilibrium, that means, let's say we're way up here somewhere. Well, in that case, the quantity supplied exceeds the quantity demanded, and the price will fall. And it will keep falling until we get back to equilibrium. If the price is too low, that means that in the opposite case, we have a shortage, basically. This is a surplus. That will drive the price back up to its equilibrium position. So in an equilibrium model, equilibrium setting, prices, or I should say, or maybe not even just prices, variables will adjust until they reach their equilibrium level. So in this case, that would be the price of the good. In the case of the CAPM, that would be the rate of return. So let's say, for example, we had this situation. Let's say that at a beta of 1, the expected return should be 10%, but we have an asset that's way up here somewhere. So in other words, even though it has a beta of 1, it's still giving a return that's higher than is consistent with market equilibrium. So that means everyone will see this. So A is undervalued or underpriced because the return is too high. Investors will buy it. The price will rise. And of course, if the price is going up, then the returns are going down. And that means that we're going to end up close right back on this. We'll move down until we reach the line again. The security market line is equilibrium. On the other hand, if we have something like this, it's too low. All right, B is down here. So B is overvalued. The price is too high, which is why the returns are too low. Investors will sell it. The price will fall. But the price falls, that means the expected return will rise because it's a cheaper price. So that means whatever cash flows or capital gains you get will result in a higher rate of return. So the return will rise. And that means we're going to find ourselves right back on the line. So in other words, the stocks out in the market that are not in equilibrium will gravitate back towards equilibrium automatically. As investors notice that some of them are underpriced, some are overpriced, they'll buy and sell, and that should push everything back towards the line. So this is an equilibrium model. We don't know how long this is going to take, but we know that it will happen eventually. Now, by the way, I do want to mention here too, the spread between what the stock is actually earning and what is predicted by the CAPM is called its alpha. So in other words, the actual return minus the return predicted by the CAPM. So up here, the stock has a positive alpha. And by the way, this is the Greek letter alpha. So here the alpha is greater than 0, which is good. Here the alpha is negative. Okay, so on the line, alpha is exactly 0. So if this is stock C, for example, the alpha is exactly 0. So it turns out that in practice, portfolio managers are often compensated by the amount of alpha they can earn for their portfolio. So in other words, if they can find bargains like stock A and scoop them up, the portfolio itself will have a very high positive alpha, and that is going to earn money, big returns to the portfolio manager because he's helping the clients. Okay, he's providing them with a better return than they might get in the market themselves. But on the other hand, a negative alpha, well, that's a different story altogether. So if you assume that the markets are efficient, but they're not perfectly efficient, at any given time, there's going to be some stocks that are overvalued, some that are undervalued. And so the portfolio manager's job is to find these undervalued ones and buy them while unloading the overvalued ones from his own portfolio. All right. Now, what's great, like I said before, because this is a linear measure, that indicates that, let me show you real quickly how this helps us. Since the beta is a linear, or the CAPM, I should say, is a linear model, which means it could be illustrated with a straight line. That's all that it means. The beta of a portfolio is simply a weighted average of the betas of the individual stocks in the portfolio. All right, so let me just show you a quick example of this. So here we go. Imagine yourself with 3 stocks in your portfolio. Let's just keep it simple. Let's see. Let me put in a little table here. So here's the stock. Here is your beta. And here is the market value. So you have stocks A, B, and C. The betas are, let's say, 0.9, 1.4, and 1.8. The stock we own $100,000, 200,000, and let's say 200,000. So it's a $500,000 portfolio. So the portfolio is worth 500,000. The weight of stock A is therefore 100,000 over 500,000, which is 0.2 or 20%. The weight of B is, of course, then 200,000 over 500,000, which is 40% or 0.40. And then finally, the weight of stock C is also 200,000 over 500, another 40%. So what is the beta of the entire portfolio? Well, what you're not going to do is add up the 3 betas and divide by 3. That would make no sense because we have more of stock B and C than A. So we have to somehow take that into account. So we're going to create what's called a weighted average. And so what you're going to do here is beta P means portfolio beta. So what are all these symbols telling us? This is the portfolio beta. This is the stock I beta, whatever that is. This is the weight of stock I. And this is the summation operator. You've probably seen that before. And so in this case, you would have 3 weights and 3 betas. Right? 3 betas, 3 weights. So this is telling me to do the following. I multiply each beta by its weight, add them up, and I have my portfolio beta. Right? So let's fill these in. So the beta of the first one was 0.9. Then we have 40% of the second beta, which was 1.4. And then another 40% of the third beta, which is 1.8. All right, so if you multiply these out, let's see, what do we get? 0.2 times 0.9 is 0.18. Then we have 40% of 1.4, 0.56. And then finally 40% of 1.8, 0.72. So you add these up and you're all set. $1.46 is the portfolio beta. So, and it's taken from the three individual betas, and the three market weights. And so that's it. Now that means that every time I should get, if you look in the CAPM model, if the market risk premium goes up by 1%, that should add 1.46% to my rate of return. So in other words, this is a very risky portfolio. It's almost 50% riskier than the overall market. But that's because you've got, I mean, let's face it, B and C are quite risky. A is pretty safe, but B and C are very risky. So my overall portfolio is very risky, but also has a very high potential rate of return. So one way we can think about this is that if the expected return to the market or the market risk premium, either one, rises by 1%, the portfolio's value should grow by 1.46 times that, or 1.46%, which sounds great, but if the market risk premium falls by 1%, well, that's a very bad situation. So yes, of course, it's a risky portfolio. Therefore, it's a very volatile portfolio. All right, anyway, but this kind of thing would not be possible with the modern portfolio theory because it's not a linear function. Okay, by having a linear relationship here, that makes it a lot easier to consolidate the beta measures for a single portfolio, and that really is very helpful. All right, so like I said, you can look throughout Yahoo.finance and see what the different betas are for a lot of different stocks. But for the most part, you'll see that the ones that are very stable, like Coca-Cola, Procter & Gamble, will have very low betas. The ones that are very risky, like Tesla, will have very high betas. A lot of banks tend to have very high betas too. Like if you go back here and look at Citibank or Citicorp, it's probably going to be over 2, or certainly very close to it. Oh, it's only 131. What do you know? All right. Well, there you go. I guess the banking system is during just even a few years ago, all the bank stocks had huge betas. I guess things have recovered in the banking sector. All right. You never know. Now, in terms of just purely economic factors that affect stock prices, these are some of the ones that you're most likely to see. Like if you're a portfolio manager, these are the kinds of things you'll be looking at very closely. We have what are known as economic factors, we have market factors, firm-specific factors, and taxes. So these are macro variables that affect really all assets in the economy, not just stocks. Economic growth. Now, stocks are especially heavily dependent on economic growth because, of course, it's the growth that makes it possible for people to buy their products, right? Now, like we were saying before, with Procter & Gamble, it's not as big of a deal because, people need to buy their products regardless of the state of the economy. But if you're selling expensive products, like if you're a auto manufacturer, then growth is a huge deal because people will not buy new cars, or they'll try to avoid buying new cars when the economy is sluggish. All right, if their growth is slow, then they'll postpone buying a new car for into the future. Interest rates, of course, the interest rates are going to be a major determinant of the cost of borrowing money for a corporation. So if they want to borrow money from a bank to help finance their whatever they're doing, higher interest rates are going to eat into their profits, of course. At the very least, it'll cause them to hold back on some of the investment spending they might otherwise take. So, and interest rates directly impact the investment spending by corporations. Of course, the strength of the dollar really mainly affects companies that do business overseas, but it does ultimately affect the cost of our imported goods too. So in a way, the strength of the dollar does ultimately affect all corporations in the US, but just some more so than others. And depending whether your company is importing or exporting, the dollar strength could have a very different impact on your stock prices. So now, of course, GDP is gross domestic product. This is a measure of the value of all the goods and services produced in a country during a given year. GDP is to a country what your annual income is to an individual, basically. So this is what we want to see growing as quickly as possible. And so in practice, our goal is to see real GDP go up by, let's say, 3% a year, because that would mean that our standards of living are basically doubling every 24 years or so. It doesn't always work out that way, but that's also a rate at which the economy can grow without necessarily triggering any more inflation. All right, now, so in other words, if let's say that tomorrow it was announced that GDP grew very rapidly in the first quarter, then the stock market would almost certainly go up as a result of that, because all the corporations out there will benefit from more rapid GDP growth. No matter what business you're in, a stronger economy is actually going to help you. By the way, I think I may have mentioned this before, but if you just want a quick look at the markets, there's a nice website here called CNBC. And, they'll give you a summary up here. Now, once the markets are closed, which is at 4 o'clock, they switch over the prices to futures. And we're going to be starting to discuss futures tonight, by the way. These are securities that enable you to essentially bet on the direction of an asset in the future. So these red numbers mean that, at least in the trading that's happening overnight or overseas tonight, investors are somewhat negative about the state of the U.S. economy. So apparently the Fed is getting ready to announce, wow, let me just see something here. When are they meeting again? I think they met like the first day we had this class, and now I guess it's time for another meeting, or almost. All right, let's take a look. Oh, all right. Well, I guess they're not actually meeting just yet. I guess they're having a conference. Now, the thing about the Fed is they try to be very cagey about how much information they let out. Because, if they let everyone know what they're about to do, it tends to reduce the effectiveness of monetary policy. So they want to keep it to themselves as long as possible. So I guess what the thinking is that if you watch Powell tomorrow, wait a minute, that's not tomorrow. What are we talking about here? Hold on a second. That was a couple of weeks ago. I remember when Trump was telling him, we really need a rate cut. Oh, there it is. It is meeting tomorrow. Oh my God, I didn't even know. The actual meeting is tomorrow. So they usually meet over 2 days. It usually takes 2 days to get everyone together and discuss all the different issues. So I guess now normally what happens is their decision is announced on let's say 2 o'clock in the afternoon on the second day. And although if the federal government sees this as a holiday on the 19th, they may wait till Friday, but still, we're going to find out real fast what Jerome Powell is thinking. And now it's always interesting to see how the market reacts to changes in interest rates, because, if they lower rates, that can stimulate the economy, but it can also speed up inflation. So sometimes the market's happy when the Fed cuts rates, sometimes they're not. I have a feeling that Powell's going to hang on because of all the conflict in the Middle East. It's the Fed doesn't like to be, let's say it's a very conservative organization. They try to avoid making a big splash when there's a lot of activity, let's say, in the world, like what we're seeing now. And they also try to avoid making rate changes just before a presidential election. So they may decide to sit on their hands for a little bit longer and wait and see what's going to happen before they decide what to do about rates. So I think if they surprise everyone with a cut, even if it's only 25 basis points, it probably would be good for the markets. The markets will probably be very happy to see that. But I have a feeling that they're not going to do anything. And then everyone will be upset, they'll be disappointed, and the Dow will go down and everything, but it'll bounce right back. The markets are heavily based in psychology. Anything that makes people unhappy will tend to cause the stock market to go down, even if there's no economic justification for it. So, but then eventually it comes back. All right, so yeah, you can see this tells me that they're pretty well convinced that there's not going to be a rate cut. Yeah, because yields are actually dropping. Yeah, so it tells me that the markets have made up their minds that nah, we're probably not going to get a rate cut this time. Oil went up a little. They're still worried about what's going on in Iran, but not that much because it's only 60 cents. Anyway, okay. So now they're saying that while they're pretty sure that the Fed won't do anything, they may, they always have remarks after the meeting is over, and people scour through those remarks to get clues about what they might do in the future. So it's really that everyone's paying attention to. It looks like they fully expect nothing to happen, but the you know the announcement that they make could have a big clue as to what's going to happen in the future. So I guess that's really what the markets are holding their breath about, not whether he lowers rates rather, but what he's going to say about it. And so he'll be very vague, very cagey, but he'll at least give us a sense of what direction he thinks the economy is going in. And if he sounds reasonably optimistic, that means that there might be rate cuts in the fall. If he sounds really nervous, he's constantly harping on inflation. Inflation is really quite low now. But he may be reluctant to do anything when there's a lot of international turmoil. So that's what we're looking at. All right. Anyway, interest rates, of course, as far as corporations are concerned, this is a major determinant of the cost of borrowing. And so the more it costs to borrow, the less likely corporations are to expand or to hire people or to buy new buildings or equipment or anything they might need. So higher interest rates are kind of a headache for corporations. So if rates went up tomorrow, if the Fed raises rates, then the markets would probably really have a rough day. But I think that they'll either do nothing, or it doesn't seem likely they'll lower rates. But again, they might send a signal to the markets that they're thinking about it. And that would be enough to keep them happy for now. The dollar. Now, of course, here's what we have to keep in mind with the dollar. Now, while this sounds paradoxical, a stronger dollar makes US goods more expensive in foreign markets. Okay, now you might say, well, a strong dollar sounds like a good thing, but this reduces US exports. And it also increases US imports from abroad, since foreign goods become cheaper with a stronger dollar. So that means the trade balance will worsen. But as far as individual companies are concerned, US corporations that sell in foreign markets will be harmed by a stronger dollar. But US corporations that import foreign goods will benefit from a stronger dollar because your import costs are lower. Okay, so in other words, if you're in the business of buying foreign goods, let's say, for example, you have a store in Manhattan and all you sell is imported British goods. All right. You love Great Britain. You love all things English and Welsh and Scottish, and your store just sells British products. A strong dollar means you're paying fewer dollars for those products that you're selling, and that would help your business. Okay. But on the other hand, if you're selling American goods in England, then a strong dollar will be a problem. So no matter what happens to the dollar, some US companies will gain from it and some will lose, depending on whether you're importing or exporting. But at the same time, though, if foreign goods become more expensive in the United States, that could affect the cost of production to American companies too. So, this one it's hard to predict sometimes what a stronger dollar or a weaker dollar might do to the US economy. But one thing we do know is that a stronger dollar worsens our trade deficit and a weaker dollar improves it. So market factors. Well, market sentiment, people get nervous, they get optimistic. Stocks are heavily prone to rising and falling with market sentiment. You know how people start getting down on the market. Suddenly it can lose hundreds of points in just a few days, even when there's no real reason why these prices should be falling. I'm sure you've seen it happen many times. People get nervous, they will start selling at the same time, the prices start to plunge, and people get more nervous and panicky. But or when the economy is just doing particularly well, the stocks might rise, even if there's no really good reason for it. So, stock markets in particular are heavily affected by market sentiment by individuals, not bonds. Bonds, not so much. I mean, unless people are worried that there's going to be a lot of defaults in the bond markets, it's really stocks that are heavily driven by market sentiment. Pessimism is never good for anyone. If investors are pessimistic, prices will fall. End of story. If they're optimistic, prices will rise. Now, occasionally you do hear research about patterns in stock prices. There's an effect that's been known about for many, many years called the January effect, where for some reason, stock prices, all other things being equal, tend to do well in January. It's like it almost never fails. If it's January, prices will go up. It's that simple. Now, one of these theories about why this is happening is that in January, portfolio managers, their performance has been evaluated for the year. Now they can feel free to take risks, at least in the beginning of the year, and then later on they can become more conservative if they have to. So they may go out of their way to buy riskier stocks, and that may have the effect of increasing stock prices because it's the start of the year. There's others too, like there's certain days of the week when stocks are more likely to rise and fall. But it's just it would be hard to make money based on something like that. Now, firm specific factors, every corporation is different. They all have different products, they have different marketing strategies, they have different employees. So some economic factors will only affect a small number of companies or possibly one company, depending on what industry they're in. So like, for example, if oil prices suddenly go up, a lot of companies' stocks will go down because that increases their cost of production. But oil companies should go up because they're selling oil at a higher price. So we have to keep those in mind too. Sometimes earnings from corporations can be higher than expected. You'll notice that there's a lot of attention paid to what Wall Street expects a corporation's earnings to be in a given quarter. And even a difference of a penny can make a huge difference to the company's stock. Like you see this happening all the time. Like let's say Apple's earnings are a penny below what they're expected to be, penny per share, that is. And then suddenly the stock drops by 20 or $30 a share because people start selling it. Like, oh, well, they didn't meet their expectations, so we're going to sell. But if they over earn, they earn more than it was expected, that can often push the stock up quite considerably. So, like there's a time of the year when a lot of these earnings are released, they are so-called earnings season, and the stock prices can be very volatile during that time of the year because all this news is coming out about all these different companies. And if the news tends to be good, then the market could go up quite considerably. If the news is kind of rough on average, then the market might go down a lot. Oh, and of course, mergers and acquisitions. Unless, I mean, almost without fail, here's what tends to happen with a merger, at least in the short run. Not always, of course, but for most mergers and acquisitions, the price of the acquired company, or the stock, I should say, increases, at least in the short run, and the stock of the acquiring company falls. Okay, why is that? Well, what tends to happen is in order to buy out another company, here's what has to happen. Suppose that Apple wants to buy out a small company that produces, let's say, AI software. Let's say for some reason this company has a particular patent that Apple wants. They like this product, but they'd rather just buy the company and do it themselves. They don't want to buy it from this company. They want to just buy the company itself. And so in order to do this, Apple must acquire a majority of the outstanding shares of stock of the software company. You don't just walk in the door and say, this is ours. The owners have to agree to sell it to you. It's like anything else you buy. You want to buy your neighbor's car. Well, you can't buy it unless he wants to sell it to you. So what they have to often do is this means that Apple may have to pay a premium in the form of higher prices to acquire the company's stock, the software company's stock. They may have to pay more than the market thinks they should have paid, because it may be that the owners of the AI software company don't want to sell. But if Apple makes them a nice enough offer, they might say, oh, all right, we'll sell ourselves to you. That's fine. And Apple may have to pay quite a bit of money for this. If they really want it badly enough, they may have to pay a huge premium to the shareholders just to acquire that stock. And so because of that, if Apple is seen to have overpaid for the stock of the AI company, even though they've acquired the company they were after, its price is likely to fall, at least in the short run, while the price of the AI company stock will rise. Okay, that's a pretty common thing to happen during a merger and acquisition like that. Now, eventually, the new company, the stock can go up if everyone thinks that the two companies are working well together, that it was a good idea to buy this new company. Not all mergers and acquisitions work out. Two companies may not really be compatible with each other. There's all kinds of potential problems that could arise. But in general, at least in the short run, when there's been a merger or acquisition, the target company or the company that's been acquired is usually often the primary beneficiary of it in the short run. It happens all the time. A lot of like you probably don't even realize it, but a lot of soft drinks you see in the marketplace either belong to Coke or Pepsi because they bought them out. I think you might be shocked if you, in fact, we could probably find a list. Look at all these. So you buy Barks root beer, you're buying a Coke product. Some of these I don't even recognize them. Body Armor, Sports Drink, Costa, um, Dasani, I think that's bottled water. Fanta, that's an orange soda. Fresca, Jack Daniels. Well, at least the Jack Daniels and Coke that you can buy in the liquor store. Minute Maid orange juice, Peace Tea, Schweppes ginger ale. Wow. Sprite. These are all Coke companies. So what would have happened is these would have started out as individual private companies, and Coca-Cola would have said, listen, it's probably going to be cheaper for us to buy out Fanta rather than produce our own orange soda. And so that's how this happens. And some companies, this is how they grow. They buy out other companies, but they're successfully able to incorporate them into their own brand. That's the key. They're able to successfully merge them into the company. Otherwise, they'll go out of business. So, and the same thing happens. Like Facebook is constantly buying out small software companies that have something that they want. I think that's how they bought Instagram. I'm pretty sure they didn't invent it. They own it, but they didn't invent it. They would have bought it out from the inventor and paid a nice premium, to say the least. In fact, this is how a lot of these internet millionaires or billionaires get to that point. They develop a nice product that somebody decides they want to buy, and before you know it, they're being made an offer they can't refuse. All right. So anyway, mergers and acquisitions, taxes. Now, obviously, taxes affect every transaction in the economy. So the risk of stocks, we've already discussed the volatility. That is simply the standard deviation of the returns to a stock. The beta, we've already discussed this. We know what it is. The value at risk is something we haven't really looked at. So just a quick refresher here again. The standard deviation of the returns to a stock is often referred to as volatility, and it measures how much the value of the stock fluctuates over time. A highly volatile stock is a very risky stock. The beta, as we've already seen, is in effect a measure of how much risk a corporation has compared to the overall market. Okay, betas above 1 indicate a riskier stock. Betas below 1 indicate a less risky stock. Oh, I didn't realize I did have an example in here. Well, all right, we can go through this one too and just see how it works. We have, it's a very similar example. 3 stocks, 3 weights. The betas are 1.4, 1.1, and 0.8. All right, let's see how this one turned out. So again, you're just literally multiplying each stock's weight, which means what percentage of the portfolio do they represent, times the betas, and come up with a total, in this case, of 0.95. Value at risk. Now, this is a little different. This is based on statistics. And basically what they're doing is they're assuming that the returns to a stock follow the normal distribution. Now, if you haven't seen this before, this is often described as what's called the bell-shaped curve. Where the middle, here's the mean, the average return. Let's say this is a stock that on average returns 10%. The standard deviation would indicate how spread out the curve is. In other words, If the returns tend to fluctuate dramatically, you might have a curve that's spread out quite a ways around the mean. And in other cases, maybe it's not spread out very much at all. Okay. So imagine here are two other portfolios with the same mean. Here we have a very high standard deviation. Here we have a very low standard deviation. Okay. And you can tell because in the first case, the returns are spread out all over the place, whereas over here, most of the returns tend to be clustered around the center near the mean. So the standard deviation is how we determine the risk or uncertainty. And so the value at risk specifically is assumed that this is how returns behave. And what it's going to try to do is it will give us provides an estimate of how much a portfolio could lose over a given time interval with a specified level of confidence. Just as a quick example, imagine that we had this situation. And let's just say that about 5% of the time, the returns to the stock are 6% or less. Okay. So what the value risk measure is trying to do is show us the left tail of this distribution, how much or what could go wrong. In this case, 5% of the time, which is equivalent to saying we have a 95% confidence interval here, or confidence level. So let's say that the portfolio is worth $1 million. Let's try this. So if, let's say, 5% of the time, the value of the portfolio is dropping all the way down to 800,000. This distance is our value at risk, which means it's $200,000 at the 95% level of confidence. Meaning that only 5% of the time should our portfolio value fall below $800,000. So it's an alternative way of measuring the risk of a stock or a portfolio. It does depend on some assumptions like the normality assumption, but it's also a very popular way of measuring risk. It's only been around for a relatively short while. This was only invented in the 90s compared to the 60s for the CAPM model. And oh yeah, and the volatility was the modern portfolio theory was invented in the early 50s, and it uses volatility as the standard deviation as its measure of risk. The CAPM model came out in the early 60s. The value risk model came out in the early 90s. So they have three different ways of expressing the risk of a portfolio of stocks. All of them require statistics ultimately, but I think the value at risk actually shares a lot of the shortcomings of the modern portfolio approach, meaning that you do need a ton of data to implement it and a lot of computer time. But you can see why that this came along in the 90s when computers were a lot faster than, let's say, in the 50s when modern portfolio theory was invented. And so, yes, it's still a very time consuming, but it's not as much of a problem as it would have been in the early days of portfolio theory in the 1950s. All right, now here's an interesting set of measures. It would be nice if we could compare the performance of different portfolios directly to each other. So there are two measures that we run across called the Sharpe Index and the Trainer Index. And so, especially the Sharpe Index is very, very popular on Wall Street because what it enables us to do is not only look at the returns to a stock or the risk, but it combines them both. So we can compare risk and return for every stock in the economy if we need to, before we make decisions about what to buy or sell. So here's formally what it looks like. So this is the expected return to the stock. This is the risk-free rate. And then in the denominator, this is the Greek letter sigma. This is usually used in statistics to represent the standard deviation or volatility. So it's an interesting measure because what they're basically telling us here is that that investors are primarily concerned with the risk premium of a stock, which means the actual return minus the risk-free return or risk-free rate, rather than the actual returns. So in other words, if you heard that a stock gave us an average return of 9% per year, this theory says, well, that doesn't tell us anything until we compare it to the risk-free rate. We need to know how much of a difference there is to determine how much we're being compensated for our risk. So the focus they're saying here is on not the actual returns of stocks, but how they compare with the risk-free rate. And then the measure also assumes that investors care about how much of a risk premium they are earning relative to the amount of risk that they are bearing. So they're not thinking about absolute returns, but how much return are we getting per unit of risk that we're taking on. Now, of course, maybe that's how people think. Maybe it isn't, but this measure is extremely popular on Wall Street because it really makes it possible to directly compare different assets. Because all assets in the economy are going to have different returns, different risks. By having a measure of relative return to risk, it does make it easier to compare them all side by side. Now, based on the way this measure is defined, as far as investors are concerned, investors would like to maximize their Sharpe ratios, or we assume trying to maximize their Sharpe ratios. Not the rates of return themselves, not the risk premiums, but the actual Sharpe ratios. Okay, so this is one of the assumptions that this measure is based on. And you can look at two different, let's say, stocks, and therefore, investors will always choose, presumably, the stocks with the highest Sharpe ratios. Okay, because this is what they're focused on. Of course, of course, this is an assumption, but the fact that everybody on Wall Street looks at Sharpe ratios is an indication that there's probably something to this. And now the trainer ratio is very similar. What's different? Oh, here's an example. Over the past 5 years, the average returns to a stock have been 12%. The average risk-free rate is 2%. With a volatility of 20% per year, what would be the Sharpe index for this stock? All right, well, you've got the average return of 12. The risk-free rate is 2. The standard deviation or risk or volatility is 20% per year. That gives us a ratio of 0.5. So if we find another stock out there with an even higher Sharpe ratio, we're probably going to buy it. Okay. It's that simple. Okay. So anyway, the trainer ratio, if you notice, let me copy the other formula so you can see them side by side and see the difference. There's only one difference. It's the measure of risk. So Sharpe ratio is on the left. This is the trainer ratio, and they're using the stock's beta as a measure of risk instead of the standard deviation. So, but otherwise, it's the same basic logic. You're creating a measure relative return relative to risk, and the difference is that this is the beta instead of this standard deviation. Now, what's interesting here is that Sharpe, William Sharpe, was one of the creators of the CAPM. As in fact, both of these guys, William Sharpe and Jack Trainer, were both involved with the creation of the CAPM model, and eventually Sharpe did win the Nobel Prize. So these are very big names in the finance field, to say the least. All right, so I think that's all we need to say for now about stocks and measuring their risks and their returns. Okay. Now that you could spend a whole semester studying the CAPM, the assumptions on which it's based, and but I think that's all we need to know. We're not going to get too deeply involved in the statistical underpinnings of it. You could certainly do that. You could get into a spreadsheet and start calculating statistical measures, and you could even estimate the beta yourself from market data, but we won't have time to do that. Okay, but instead, we're going to move on to something really exciting and really different. And so the last couple of chapters of this course are based on a very important market that's only really been around a relatively short period of time. And that would be the market for what are called derivative securities. Now, these get a lot of attention in the media because derivative securities are very useful as hedging instruments, but they can be used to gamble too. In other words, just to speculate, are useful hedging instruments, meaning that they're used to reduce risk, but can also be used for speculative purposes, by which we mean gambling. The unfortunate thing, though, is that if they're not used wisely, they can lead to catastrophic losses. And they have in many cases throughout the last 40, 50 years. There's a lot of stories that would make your hair stand on end about losses to traders and investors, and because they thought they understood how these derivatives work, and apparently they didn't. Either that, or maybe there was some bad luck involved. But if you buy stocks, come on, what's going to happen? The worst that can happen is the price falls to zero and you lose 100% of your money. With derivatives, you can lose any number of times what you started out with if you're not using them correctly. There's one case in Orange County. The treasurer of Orange County in the 90s was he was buying derivatives based on mortgage-backed securities, if I remember correctly, and he lost like 3/4 of the county's money one year because he didn't know what he was doing. Um, there was a bank called Barings Bank in Britain that went out of business because one of their traders lost a fortune trading derivatives behind their backs. They didn't know about it. And so there have been a lot of disasters that have taken place through the misuse of derivatives. In fact, Warren Buffett, the famous investor, once referred to them as financial weapons of mass destruction. And he always said, listen, I won't touch these things. I don't get them. I don't want to know about them. So why do they even exist in the first place? What is the purpose? Well, because they can be tailor-made to develop hedging strategies, I should say, for market participants. So derivatives were introduced to make it much easier to hedge risk. Now, of course, the word hedge here means to minimize. And we'll see a lot of examples of this as we go along. So in other words, the purpose of these securities is to make it easier to at least control your risk or rearrange it or do something to make it more palatable to you. And if they're used like that, they can be very, very successful. I mean, they can be used to get rid of any number of types of risks. But if you're a speculator, you can use these to hopefully make a lot of money in a hurry, but you can also get wiped out very quickly. So there's different categories of derivatives that we want to learn about. We'll start with the simple ones. So if you look at chapter 13, we'll start with the case of what are called forwards and futures, or forward contracts and futures contracts. Okay, so those are the earliest types. They're the simplest. Now they can also, cause you to lose a lot of money, but they're easy to use for hedging purposes. So the simplest types of derivative securities are forward contracts and futures contracts. Now, these have been around for a while. In fact, supposedly forward contracts have been around since even pre-biblical times. I mean, this is not a new idea at all. Futures contracts have not been around quite so long. But even then, like in the United States, futures contracts have realistically only been available since the middle of the 19th century, just before the Civil War. So compared to stocks, let's say, they're quite a new type of security. And so these contracts enable the owner to lock in the price at which he or she can buy or sell an asset in the future. So how does that help? For example, suppose that a jewelry manufacturer knows that he will need to buy 100 ounces of gold on, let's say, July 1st. Okay, because he's in that business. It's, let's say, normal every July 1st, the company needs 100 ounces of gold to keep their business going. And so it's almost July 1st, we're going to need to buy gold. Now, we know that gold prices are very volatile. The manufacturer can wait until July 1st to buy the gold. But this introduces the risk that the price will rise by July 1st. And in the case of gold, it can go up quite a bit. If there's any more, let's say, chaos in the Middle East, the price could go up quite dramatically. Well, that's not too cool. In fact, you know, I'll tell you what, just out of curiosity, let's see where it's going. $34.0960. Okay, it didn't go up as much as I would have thought, considering. Let's look at the last year. Just since the start of the year, ooh, that's a nice little increase. But the thing is about gold is it can go up $500, $600, $700 an ounce, and then it can go right back down again. It's very, very volatile. Gold prices are notoriously volatile and respond quickly to world events, let's say, because gold is seen as a quote safe haven by investors, meaning that when they're nervous, they may buy gold instead of holding other types of assets like stocks. So if there's more trouble in the Middle East, gold prices will probably go up, and they can go up quite a bit. Now, of course, you know, they are an industrial metal too. Like here, the manufacturers using them to make jewelry. So there's that component of the demand for gold is fairly stable though. But you know, the price of gold will bounce around when things are going, let's say a lot of activities happening in world markets. So now, besides waiting till July 1st to buy the gold, the manufacturer can also borrow money and buy the gold today, which eliminates the risk of a higher price, but also represents a cost in the form of interest. In other words, you know, you're looking at like a few weeks of 100 times this number. How much money is that? Hold on a second. That's $340,000 you've just borrowed. Even if it's just for a few weeks, there could be a lot of interest involved for that. And you may not want to pay that. And, you know, it just might be awkward to store the gold too, because now if you buy the gold, you have to do something with it. So what can we do instead? Forward and futures contracts can be used to lock in the price of gold on July 1st without any risk and without the need to borrow money or take possession of the gold now. It sounds awfully convenient. So let's say, so the current price of gold, as you saw, let's say it's 34.0690. Now, here's the interesting part, and we'll have to discuss this more in a bit, but suppose that the manufacturer approaches a financial institution who is willing to enter into a forward contract to deliver the gold on July 1st. So in other words, you have to find a financial institution that's willing to get into this contract. The financial institution agrees to deliver 100 ounces of gold on July 1st. Now, the tricky part here is what price will they have to pay? The price that will be paid on July 1st is written into the contract today. So in other words, you already know in advance what it's going to be. Suppose that price is 34 450. We call that the forward price. And that means that on July 1st, the gold manufacturer will pay on 3045 for 100 ounces of gold. Okay, now, of course, I just completely made up that forward price, but I'll show you later on where it comes from. And so this means that while, we're locking in a fairly high price, it means we don't have to worry about anything. If the price goes up to 3,600 by July 1st, no problem. We're still locked in at 3,450. So the manufacturer, and by the way, they don't have to pay for this until July 1st, has locked in a price and will not need to make the payment until July 1st. Okay. So now this means that no matter what the price is of gold on July 1st, the manufacturer will only have to pay okay. Now, of course, this is great. If the price goes up, we saved a lot of money. But if the price goes down, unfortunately, we still have to pay 304,500. So there's kind of you're locking in a price, but that means that the price could go up and you'll save money, but it could also go down, and that means you won't be able to reduce your expense, but at least you have a locked-in price. Okay, so that's what the purpose of this is. So the manufacturer has eliminated all of their price risk by entering into this contract. Now the seller, the financial institution, is also going to receive only 304,500 no matter what the actual market price is on that day. So the financial institution is taking on the price risk that the manufacturer is eliminating. So that means, let's say the price does go up. The financial institution must deliver 100 ounces of gold for 304,500 when the market price is $350,000. So in other words, oops, they just lost a lot of money because they entered into this contract. On the other hand, if the price falls to, let's say, 3,500, not 3,500, 3,300, let's say, per ounce on July 1st, then the manufacturer is paying $304,500 for gold that is worth 330,000, and the financial institution is receiving 304,500 for gold that is worth 330,000. So in other words, they both have opposite sides of this risk. The manufacturer is locking the price, and any gains they make will come at the expense of the financial institution, but any losses they suffer will go into the pocket of the financial institution. So, and by the way, the manufacturer is said to have a long forward position, and the financial institution is said to have a short forward position. Okay, so these contracts, these forward contracts are not actually traded in the marketplace like stocks are. Instead, they are negotiated between two what are called counterparties. Once that happens, you realistically can't buy or sell this contract from somebody else. It's an agreement. It's a legally binding agreement. So you're kind of stuck with it. You know, is you really you have to follow through with whatever you agreed to, but there's no actual market for these. You're just directly trading or entering into these agreements with a counterparty. So the point of these, the purpose of these, again, is to eliminate your risk. Now, you could use these to gamble too. I mean, you could enter into a contract to buy gold and hope that it goes up or down or whatever. But mostly these are used for hedging purposes, and you can see they're very flexible. Um, you can agree to buy or sell anything with one of these contracts. These contracts are very useful for customizing a hedging program. They can be used to buy or sell any asset for delivery at any time. So you can see why they're so popular. The volume of trading of these, or the volume of these contracts that's entered into every day is astronomical. I mean, in the foreign exchange markets alone, there's like something like $2 trillion worth of these entered into every day. So forward contracts are very popular for hedging foreign exchange risk. So companies that do a lot of business overseas, they're always worried about the dollar, how strong it's going to be, because that'll directly affect their profits. So a lot of trade is also when there's a lot of trade, we also see these contracts entered into to eliminate foreign exchange risk. It's a very common thing. So because who knows what's going to happen to the dollar? And so, a lot of these companies, they don't want to take any chances. They're in the business to buy or sell merchandise, not to take chances on the foreign exchange markets. So there's a lot of activity with forward contracts in the foreign exchange markets. Now, all right. So we're gonna get back into this in a second, but futures contracts, as we'll see in a minute, are very closely related to forward contracts. There's several important institutional differences between them, but they're basically operate the same way. Their goals are the same. The purpose of having them is the same, but there are some very important differences. So we'll look at these. But first, looks like we have to have our break. So we'll come back here at about 8:30 or so, and then we'll start to dive more deeply into forwards and futures. Okay. So I'll see you all in a bit. All right, so we can carry on from here. We're going to be looking at forwards and futures. So, of course, as we've seen already, the forwards and futures are types of derivative securities. And so the reason why they're called that is because their value depends on or is derived from the value of an underlying security or other asset. And that could be literally anything. It could be a stock, a bond, it could be gold, it could be oil, it could be anything you could imagine can act as the asset that underlies a derivative security. So forwards and futures are there to let us either buy or sell these assets at a price that's specified today. And you'd be surprised some of the things that are available out there. There have actually been derivatives written on things like uh, temperatures and snowfall and rainfall. So, in other words, the sky's the limit when it comes to derivatives. And of course, there's a valid reason for doing this. Imagine you're a farmer and you're worried about the temperature being too high or too low, or there not being enough rainfall. We can enter into one of these contracts where you'll get paid if the weather is not good enough for your crops to grow properly, for example. Now, by the way, I do want to mention here that you know that stocks are traded through exchanges like the New York Stock Exchange. There are actually specialized exchanges that deal in derivatives. So one of the biggest in the world, if not the biggest, is the Chicago Mercantile Exchange. Let me show you their website real fast. And so you can see they have a lot of derivatives that anyone, let's see. Oh, I don't think this is what I wanted. Yeah, this must be it. Okay. No, that's not it either. What's going on? Hold on 1 second. Wait, no, here it is. That's all right. This is what I was looking for. All right. So this is the Chicago Mercantile Exchange's website. And you can see if you look over here under markets, all the different kinds of derivatives that they carry. You can see, for example, they have derivatives written on corn and soybeans and oil and natural gas and the S&P 500 and the NASDAQ, the euro, 10-year treasury notes, SOFR, which is the Federal Reserve's overnight rate at which banks can borrow and lend among themselves, gold, copper, agriculture, cryptos, you name it, it's all here. So these products are traded through this CME, which is an exchange, which only does derivatives. They do not deal in stocks. Okay. Now there's others too. There's quite a few others, but this is the largest one in the United States, at least. And so some derivatives are available through exchanges, but there are others that are available only in the so-called over-the-counter market. Now, if you remember how we described that with stocks, the over-the-counter market is where securities are traded directly between dealers. So the over-the-counter market, so often it's called the OTC market. So where securities are traded directly between dealers. So in the stock market, as we mentioned last week, stocks, penny stocks, as they're called sometimes, or we could just say the stocks of small companies are traded in the over-the-counter market as the exchanges will not list companies that are, don't have certain minimum size requirements. Like, it's not the case that anyone who issues stocks can get traded on the New York Stock Exchange. There are certain requirements. I'm not sure how large the company has to be. In fact, we could probably look this up. Oh, here it is. Company must have at least 400 shareholders who own more than 100 shares of stock. There must at least be 1.1 million shares of publicly traded stock, and the market value of these stocks or market capitalization must be at least $40 million. Okay, so obviously, if your company is smaller than that, you can still be a corporation and yet still not be large enough to qualify for being listed on the New York Stock Exchange. So, um, the stocks, all right, so let me rephrase this a little bit. The stocks of companies that are too small to be listed on an organized exchange are traded in the over-the-counter market. So tiny little companies, that don't have a whole lot of shares of stock outstanding, they're still available. You and I can still buy them. It's just that we have to have a dealer go look and call up other dealers and find out who's got shares available. And it's going to be a more time-consuming process, probably more costly, but it certainly can be done. Okay, so in other words, the dealers get together and they buy and sell among themselves for their clients. And so this way, there's no exchange involved. And so, but within the derivatives markets, we also have an over-the-counter market. So it's a little bit different there because size is not really the consideration here. Um, some types of derivatives are only available whoops, through exchanges. Some are only available through the over-the-counter market, and some are available on both. So the size is not really what determines this. It's the type of product. Okay, so as it turns out, forward contracts, which we've discussed already, are only available in the over-the-counter market. Whereas futures contracts, which we haven't started discussing yet, are only available through exchanges, such as the CME. Okay, and so as we'll see next week, options are available in both places. So now there's a lot of implications of this. It affects the risk that you're facing when you own these securities, and other details depend on whether they are traded in the over-the-counter market or through exchanges. But I'll just, yes, so here we are. Some of the exchanges you'll see in the United States are the CME, the New York Mercantile Exchange. In London, we have the London International Financial Futures Exchange. So, most countries do have at least one derivatives exchange. Sometimes you never know. Occasionally you'll be surprised. Like, for example, the Philadelphia Stock Exchange actually does deal in currency options and other types of derivatives. But usually an exchange either does stocks or they do derivatives. They don't normally do both. Although there's nothing to stop them. It's just not the way things are normally done. All right. So the OTC derivatives are the ones that trade in the over-the-counter market. So there's some good things and bad things about the derivatives, these two markets, exchanges and the over-the-counter market. I just want to mention a couple of them. The advantage of trading on an exchange is that the products or the securities that are being traded are guaranteed by the exchange. In other words, if I'm a buyer of one of these derivatives and I buy it through the Chicago Mercantile Exchange, then I don't have to worry about any issues where, let's say, the seller is going bankrupt or anything like that. Whereas in the over-the-counter market, there's credit risk as counterparties uh, can go out of business. So if you enter into a deal to buy shares of stock, let's say from a counterparty in 6 months or something like that, and the counterparty goes out of business, well, you're out of luck. Okay. So in the over-the-counter market, you don't have any protection from credit risk like that. Whereas the exchange itself acts as the guarantor of every one of those transactions. On the other hand, um, usually the over-the-counter markets can provide more flexibility. We'll discuss this in a few minutes when we start looking at the differences between forwards and futures. Because this is where you can essentially buy or sell anything that you can find a counterparty for. Whereas with the exchanges, they only sell certain products and that's it. If they don't have it, you're just out of luck. Okay, so we'll see as we go along that there's a lot of good things and bad things about trading on exchanges versus over the counter. All right, so as we've already seen, there are forwards and futures. We'll also briefly discuss swaps, and then there's a separate chapter for options. Those come last because they're the most complicated. They're the most powerful, but they're also the most difficult to understand. But we'll be able to explain them very well with graphs and with Excel. But options are the ones where there's a lot of rocket science involved, so they can get horribly complicated. But we can learn the basic features by looking at a series of graphs and that explain how their payouts work, and we can also understand by using Excel. So we don't have to get too bogged down in math. Forwards and futures are very straightforward math-wise. A forward contract, as we've started to see, is an agreement. That's all it is. It's a legally binding agreement between two counterparties to buy or sell an asset at a specified date in the future at a price that's agreed on today. And this is the important part because this is what makes it possible to hedge our risk. Okay, in other words, the jewelry manufacturer in our previous example was able to lock in the price at which they could buy gold by entering into a forward contract and eliminating all of their price risk. So that's what makes them so powerful. And the details, what asset we want to buy or sell, how many units, when in the future do we want to buy them or sell them, all those are written into the contract, and we can negotiate every single detail with the counterparty until we're both happy. So here's a quick example with currencies. Let's say the exchange rate between the dollar and the pound is $1.69.80 per pound. And now here, this number, the 6-month forward exchange rate, what this refers to is if I choose to buy pounds in 6 months, the price I'll pay when they're delivered is this number here. We call that a forward price or forward exchange rate. Okay, this is the price that I'll pay for immediate delivery of the pound. That is referred to as, let me just make a note here. Since this is the current price of the pound, this is often referred to as the spot exchange rate. And then this number is called the 6-month forward exchange rate, where we have to specify the time frame because we need to know when the currency is going to be delivered. So when you go to buy currencies, let's say you're getting on a plane to London tomorrow for a business trip, and you find out that it's going to cost you, let's say, $1.30 per pound. That is a spot exchange rate. But if you're a business that needs to buy pounds for delivery in 6 months, the price that you were quoted is a forward exchange rate because the delivery takes place in the future. Now, you're probably wondering, why aren't these two numbers the same? Well, we'll find out in a few minutes why. But there's a very precise mathematical relationship that ties them together. And that relationship is based on the time until the exchange rate, the currency rather, is delivered, and the interest rates in the two countries. So we'll see how that works in a bit. So yes, so in other words, as I was just saying, this number, the spot exchange rate, means I can buy all the pounds I want today for $1.69.80, but for delivery in 6 months, they're going to cost me $167.15. And by the way, notice that the forward price is lower. It can also be higher. And again, that depends on the interest rates in the US and the UK. All right. So with this price, what this means is that a US importer who needs to buy 10,000 pounds in 6 months can enter into this contract and say, listen, I'm worried about the future direction of the dollar. If the exchange rate goes up, it's going to cost me more pounds, and I don't want that. So I can enter into a forward contract now with a financial institution and an investment bank, and then I can enter into the contract in which I can agree that in 6 months I'll buy 10,000 pounds, and at that time I'll pay 1.6715 each, or a total of $16,715, no matter what the spot exchange rate is in 6 months. So I've locked in the price, and I don't have to worry about it anymore. Okay, it can't go up, but it also can't go down. So I'm locking in the price. All my foreign exchange risk is gone. That's the beauty of this setup. And by the way, I think, I mentioned this earlier, the importer, because he's buying, has the long forward position. So since the importer is buying pounds, he is said to have a long forward position. The financial institution is said to have a short forward position. Okay, so they enter the contract in 6 months, payment will be made, delivery of the pounds will be made, and that's the end of that. So, yeah, so I mean, an investment bank would take care of this. If you're a large corporation and you have a business relationship with, let's say, JP Morgan Chase, you can call them up and say, listen, I need to buy pounds in 6 months, and they'll give you a quote. Okay. It's a common thing, especially for banks that deal in foreign exchange. Now, obviously, not all financial institutions are willing to do this, but there's plenty who will, and you can just enter into a contract with that financial institution. Now, of course, from our perspective, the importer has locked in the price. The price can't go up. It can go up, but I won't have to pay it. But if it goes down, I can't save any money. So I'm locked into my position. Now, by the way, just as a side note, especially in the foreign exchange markets, and stocks too, by the way, it's a dealer market, which means that there's two prices. The dealers make their money by offering to buy or sell from anyone who's interested. And so the way they make their money is by saying, listen, let's say people want British pounds. If they want to buy British pounds, we'll sell them for $1.42. But if they want to sell them back to us, we'll take them off their hands for $1.32. And so the difference between the two, that 10-cent difference, is referred to as the bid-ask spread. Okay, now if you've ever traveled abroad, you know that the actual spread is probably going to be a lot larger than that. The difference can be quite considerable, and that's because you're probably only buying a relatively small number of pounds. So, they have to make money. They might also charge you a fee on top of that. But for larger transactions, the spread will be much tighter. Okay, so like if I'm buying 100 pounds, 10 cents a pound, that's a $10 fee. If I'm buying 1,000,000 pounds, then the spread might be a fraction of a penny, because it's still a large amount of money, even a tenth of a cent on $1,000,000. Let me quickly check this out. That's still $1,000. Okay. So the size of the bid-ask spread will depend, among other things, about the size of the transaction. Also, it'll depend on the currency itself. For currencies that don't trade very often, it'll probably be wider because the dealer is assuming more risk by dealing in that currency. Oh yeah, like here's another example. If you notice here, because it's such a large transaction, the bid-ask spread is a fraction of a penny. It's only um, 0.2 $0.002 or 0.2 cents. Okay, because it's such a large transaction. But still, that's $2,000 for one transaction, not too shabby. Now, by the way, if you've ever looked at foreign exchange quotes online or in the newspaper, you'll notice something interesting here. Let me just show you quickly Bloomberg's website. This is where you can find out the current currency prices, and these are actually being updated if you watch this page long enough, you'll notice the changes. Although it's getting late at night. Now, the thing about currencies that's different than stocks is now American stocks tend to only trade during normal business hours, although there might be some trading overnight um, in foreign markets. But for all practical purposes, American stocks only trade while the New York Stock Exchange is open. Currencies are completely different. They never stop trading. It's a 24/7 market. And so even when, all the markets are closed in New York, there might be open in London. If they're already closed in London, they'll be open in Tokyo. So there's almost never a time of the day when there's no foreign exchange trading taking place. So these numbers will probably update themselves every so often. And so what are they telling us? For example, this one tells me that each euro that I want to buy would cost me $1.14.96. This quote tells me that every dollar would cost me 145.28 yen. Every pound, British pound, will cost me $1.34.38, et cetera, et cetera. So these numbers are not the prices at which you'll actually make a transaction. These numbers are actually the midpoints or halfway point between the bid and the ask price. So somebody sat down and calculated what the midpoint is of all the different bid ask quotes, and that's where these numbers came from. So if you're actually going to make a transaction, your numbers will be different depending on whether you're buying or selling. The Wall Street Journal quotes exchange rates with a midpoint between the bid ask spread for very large transactions. I think their number is $3 million or more. So it's a little bit deceptive. You and I are not going to pay those numbers, but it still gives you a sense of how the currency is doing compared to, let's say, yesterday or last week. You can still keep track of how strong the currency is with these numbers, but you have to be aware that they're not actual market or they're not traded exchange rates. All right, the over-the-counter market. By the way, if you're interested in any of this, our old friend Fred will have quotes for many of the major currency pairs. Yeah, so this is what we're looking at right now. So about $1.35. Now the British pound goes through cycles like every other currency. Throughout its history, the pound was usually worth more than $1, of course. In fact, in the early 20th century, there was a point when each pound was worth nearly $5. But throughout much of the later half of the 20th century, it was more normal for the pound to trade at around somewhere between $1.50, $1.60, maybe $1.70. And now, after Brexit, it's been in the 120, 130 range. We'll see if it ever comes back. In fact, right about here, wow, 109. Wow, that's really, you don't see that at 107. I don't even remember what was happening at the end of 2022. What was this all about? I don't know. I'd actually have to look that up. It doesn't ring any bells. Now, the COVID was over here, but wow, what was going on here? I honestly don't remember, but it's now back up in the 130s. And but if you go back far enough, you'll see that there have been times when, like, yeah, here's the COVID. It was quite expensive, and other times when it was quite cheap. Like in the early 70s, if you notice, it was more normal for the pound to be up over $2 a pound. And then around 85, oh my God, 107. So it bounces around, but it's always been worth more than one US dollar. All right, so over the counter market, which are the forward contracts are negotiated between counterparties. And again, this is what gives us a lot of flexibility, because we can specify what we want to buy or sell, when we want to buy or when we want to take delivery, for example. So here's a classic example of this in the foreign exchange markets. As an example, suppose a US company does business in Iceland. That means they're earning revenues in the Icelandic currency, which is called the krona. Now, of course, when you earn a foreign currency, you're taking a terrible risk because you don't know what its value will be against the dollar. If it fluctuates, if the krona becomes worth less dollars, then you're going to have potentially losses on your business, even though you have a successful business. The value of the krona, if it deteriorates, it could cause a lot of problems for you because you're going to get less dollars than you were expecting. So now, this is not a heavily traded currency, as you can imagine. It's a very, very small country. So the company could, in principle, buy or sell krona. Kroner, it's actually, when it becomes pluralized, it's kroner. Through a forward contract, they'd probably have to find a foreign bank that does a lot of business in Iceland. But this we'll see in a little bit. Exchanges such as the CME do not deal in kroner due to their low trade volume. So in other words, if you want to hedge your risk in kroner, you really have to go to the over-the-counter market. You can't expect to find them available on the CME because they're not there. They only deal in the very high volume assets. So that would be one advantage to go into the forward market. And another thing too is that you can specify, again, assuming you can find a counterparty who's agreeable to this, you can specify any time of delivery. And also the quantity of krona that they want to buy or sell. In this case, they want to buy. I'm sorry, they want to sell because they're importers. No, wait a minute. They're exporters. They're selling U.S. products in Iceland, and they're receiving kroner in exchange for that. So also the quantity of kroner that they want to sell with a forward contract, that is. So they have complete and absolute flexibility. Of course, again, assuming you can find a counterparty who's willing to take the other side of this. But like I said, if you were to approach a commercial bank or investment bank that does a lot of business in Scandinavia or that area, you probably shouldn't have a problem. But we'll see later on that that's not the case with futures contracts because they are traded through exchanges. The words long and short here mean long means you're buying, short means you're selling. Oh, by the way, here's a quick review. imagine you're dealing with foreign exchange forward contracts. Just a quick review of how this works. If let's say the exchange rate between the dollar and the pound is $1.30 and it goes up to $1.35, which currency just became stronger and which became weaker? Well, it turns out the dollar got weaker or depreciated because it now takes more dollars to buy a single pound. At the same time, though, the pound has appreciated or gotten stronger because, again, it takes more dollars to buy the same pound. Now, imagine yourself being a U.S. importer who's committed to buying 100,000 pounds worth of British goods in 6 months. Well, you know what? If the exchange rate does in fact rise from $1.30 to $1.35, look what happens. Oh no, instead of paying $130,000 for those pounds, you have to pay $135,000, which could eat up your entire profit margin. So a depreciating pound is the worst thing in the world that can happen to you. Of course, there's a chance too that the dollar will get stronger, and that will put more money in your pocket, or actually it would save you some money, but you don't know if that's going to happen or not. So why not lock in your price now and get rid of all this risk? So that means you're hedging your risk by locking in the price today. Okay. So the owner of the business is trying to make a profit from the British goods themselves. They're not trying to speculate on currencies. That's a different game altogether. So you're selling British goods in your store in the city, let's say, and so your job is to make profits from the selling the British goods to the public in the United States, and you're trying to eliminate all other forms of risk. So you don't want to have to deal with foreign exchange risk. So that's when you would use a forward contract. And let's just say that the quote that they're given in order to do this is $1.32 a pound. So therefore, no matter what happens to the pound in the next 6 months, when the 6 months are over, we're going to pay $132,000 for 100,000 pounds, no matter what's going on in the markets. Now, here's a quick graph that will help us understand. This is a different example, but what they're saying to us is, let's say that the forward exchange rate is $1.70 a pound. We need to buy 100,000 pounds in 6 months. With a contract like this line in the middle, the straight line, is the hedged position, meaning that's how much we'll pay regardless of what happens to the pound in the future. The upward sloping line is what will happen if we don't hedge our position. And you can see that every time the exchange rate goes up $1, that's going to add $100,000 to our cost. So it's a straight line with a slope of 1. They cross at 170. At $1.60, it saves some money. At $1.80, it will cost us more money. But the bottom line is, with $1.70 locked in with the forward contract, we have nothing to worry about. With the unhedged position, we have plenty to worry about. We might make more money. We might end up paying more money. You don't know. All right. And so, by the way, the logic behind hedging is that if you're worried about the price going up, you can hedge it with a long forward position. If you're worried about the price going down, you can hedge it with a short forward position. Right, so that's what we have here. This is the summary of that. Because if you lock in, if you're buying and you don't want the price to go up, if you buy a forward contract and the price does go up, well, it doesn't matter. You're going to pay the same price either way. And the same thing with a short position. Now, here we go. Now, of course, not everybody in the market is hedging. A lot of people are using these contracts to speculate. And of course, the word speculate means gamble. With a hedge, you're reducing your risk. With a speculation, you're increasing your risk with the hopes of making a profit. So how would you make money in this market if you were a gambler? Well, let's say you're not doing any business overseas, but you just think that the pound will become more expensive. All right. So here's a quick example. An American investor thinks that in 6 months, the dollar pound exchange rate will rise from its current $1.30 per pound to $1.40 per pound. Okay. So the investor will enter into a long forward contract. And let's say the forward exchange rate is $1.32. So how does that help? All right. Oh, and by the way, let's say the amount involved is 100,000 pounds. Um, right. So you've locked in, you have an obligation now in 6 months to buy 100,000 pounds for $1.32. So what if the investor is right? If the spot exchange rate is $1.40 per pound in 6 months, then the investor is in good shape because can buy 100,000 pounds at $1.32 each for a total of $132,000 and then sell them in the market at $1.40 per pound for a total of 140,000. So they just made an $8,000 profit. Now, the beauty of this contract is you don't actually put up any money in the beginning. So this profit did not require any investment on your part. You just enter into an agreement, and now 6 months later, you collect your profit. That's the end of it. On the other hand, of course, if the exchange rate falls to $1.30 per pound, or let's say, ooh, even worse, $1.20 per pound, the investor is paying $132,000 for pounds that are only worth $120,000. So you could get clobbered. I mean, because you remember you didn't put up any of your own money. All of a sudden you're down $12,000. What do you do now? So you can see it's a terribly risky thing to do. But you know what? If you're determined, and a lot of investors do speculate as well as hedge. And so this is one way we could do this. If you expect the price to go down, you do the opposite. You just take a short position because you'll make money then if you're right. All right. So in other words, you're when you're hedging, or I'm sorry, when you're speculating, if you expect to, let me just summarize this here somewhere. An investor who expects the price of an asset to rise in the future can speculate by entering into a long forward position to buy the asset at a price determined today. And of course, an investor who expects the opposite they can speculate by entering into a short forward position to sell the asset at a price determined today. So that's how you would go about that. Okay, now, of course, the idea here is you need to get this part right. I mean, if you got this backwards, you're going to lose money even if you're right. All right, so now what's still coming up here is we're more or less done with this discussion about forward contracts. What we really want to know is, how are futures contracts similar, and how are they different from forward contracts? When would you use one versus the other? What are the advantages? What are the disadvantages? And so that will be coming up next. And when that's done, we're going to move into the world of options. Now, when we get into the options discussion, we're going to have a lot of spreadsheets to do, because I was saying before, options are fairly complicated, but luckily we can understand their basic features by using graphs, which we can set up in Excel, and we'll then gain an understanding as to how they work, and how we can use them for hedging purposes, but also how we can use them for speculation purposes. So that's going to take a little bit longer. They're much more complicated than forwards and futures. So it'll probably take a couple of classes to get through our discussion about options. So, well, it's getting kind of late here, so maybe we'll hang on to that. First, next time we will finish our discussion here. We'll go over what futures are and how they're different, and then we can at least introduce options next time. And so I think you'll find that they're an extremely interesting type of security. And you'll be very surprised when you see what's possible with options. Let's put it that way. So something to look forward to. So I guess we'll call it a night, and I'll see you all on Thursday.
Thank you so much. Have a good night.
Good night.
Thank you. Have a good night.
Good night.